Hello, everyone. Welcome back to the Market Chat. My name is Richard Moglen. Joining me today is Austin Lieberman, one of the lead advisors over at 7investing.com. Austin, thanks so much for being here. Welcome to the show.
Hey, thanks, Richard. Big fan of yours. Been a fan of your work for a long time, your YouTube channel. Excited to watch you out there interacting and growing on Twitter. And I think that's like helping your YouTube channel as well. And then just love learning from you as a, you're more of a, I think you probably consider yourself like a swing trader type of person, or is it, or can slim?
Yeah. More of a techno fundamentalist. So I look at both the fundamentals and also the technicals at the same time.
That sounds like a type of dance move or something, techno fundamentalist. And I'm not making fun of you, but the point I'm making is that I think we have very different styles, and I respect your style a lot and learn a lot from you. And you've had a lot of like interesting people on the channel that have, kind of similar styles. And I think what I'm going to talk about today is probably a little bit different than what your audience prefers. And so if you don't like somebody that doesn't use any charts or any technicals and talks about long-term investing, then just stop listening now. But if you're open to that, then this is going to be a great talk, which I know you are, Richard. I'm just trying to set the expectations for your fans who might hate me.
No, I'm sure they won't. And it's awesome to have you on. And I think, like you said, there's so many different ways to invest, to trade, and we can learn something from everybody else. So I'm excited for this. And I always like to start off with a simple question. How did you get interested in this, and what's kind of your investing journey?
Sure. Yeah. So until I started as a lead advisor at 7investing in March, investing was not what I focused on day to day. I had full-time job. I was on active duty on active duty in the Air Force from 2011 to 2018. And then before that, I was in college, and before that, I was growing up. So I really started investing after I commissioned after college. A little bit before that, I had a college loan. Well, it was I was in ROTC in college, which is Reserve Officer Training Corps. And what that is that's just how you become an officer from college in one of the branches of the military. Mm-hmm. And so with that, you do the training for your 4 years of college. And then you know that as long as you graduate and you don't mess up, you're going to go off and start a career. And for me, it was the Air Force. And so I knew how much money I was going to make starting, because all of that stuff is out there. It's public information. But with that, there's a couple military friendly banks out there that provide what's called career starter loans. And because they know you're going to get a reliable job, there's obviously a background check and stuff like that, or a credit check, but the requirements aren't super high because they know you're going into a career right out of college. So I got this $25,000 loan from USAA. It was at like 3% or 3.25% back in 2011, which felt low, but now it's just, things are even lower. And it's meant to help you like do your first move and set up your house or your apartment and buy the things you need to start your career. And so I took like half of it, and we went on an awesome cruise. You get it your senior year of college. We went on an awesome cruise our senior year. I bought like 2 road bikes for my then fiance and now wife and myself. And then a couple other things I really didn't need. So I didn't really use it for the purpose of the loan, but I had like 50% left over. And I was watching Jim Cramer, and I had been interested in stocks and investing because my grandfather was kind of a businessman. And every once in a while, when I was at his house, he would be like reviewing the newspaper that had, the stock prices of the day, because that was how you got stock prices way back in the day in 2006, 2007, or whenever it was, which really isn't that far back in the day. But I just like to say that because it makes me feel smart. And so had that loan, I had about, we'll say like $10,000, and I was watching CNBC and watching Jim Cramer. And that to me was investing at the time. Right. And he was, whatever stock he was talking about of the day, I ended up buying a little bit of AT&T, a little bit of a REIT, NLY was the ticker, which is Annaly. I don't even know if it's public anymore. And then I owned something related to the volatility index, the VIX. And I don't even remember what it was, but it was like one of those leveraged ETFs or something like that, where if you stay invested in it, you're guaranteed to lose money. They're made for like short-term stuff.
Yeah.
And I had no idea what I was doing. I didn't know anything about these companies. It's just Jim Cramer talked about it. And I was like, oh, he's smart. He's a millionaire or whatever. And so I quickly lost like 50% of that $10,000. Thought investing was a scam and kind of like put it on the back burner. That was 2011. And so then commission, and I went through to start, I had about 2 to 3 years of training and didn't really think about the stock market. But then got to my first assignment, and the job I was in, I was a tactical air control party officer, which is we do close air support and airstrikes for the Air Force. So on the ground with the Army or with maybe some of our international allies, and we were the people that were coordinating with the Air Force and with the pilots and doing all the planning to be able to effectively drop bombs from aircraft onto the battlefield. And there's a lot of training and stuff, and it sounds like super dangerous, and I guess it is. And I guess if you don't like that type of thing, you might think I'm a bad person now. But there was a lot of we tried to be as careful as possible, and we tried to, even though it was a destructive job in a way, we tried to be as helpful to people that were doing good things in the world as possible and save as many good people as possible. But the point is that I had about 3 years of training. And so I didn't even think about investing. And then it's a very close knit community. And so when I got to my first assignment, I kind of had a mentor that I looked up to, and we were just in the office one day, and he was at about his like 16 or 17 years in the military. And if you get to 20 years in the military, you can get out and you have a pension for the rest of your life, or until that goes away, which hopefully it doesn't. That's like basically 50% of what you made in your last year in the military. And this person was just not worried at all about like what he was going to do after he got out. I mean, it would be great to have that pension, but even if it didn't, he was going to be fine. And I just got to learn like how he got there. And the way he got there was he just put a amount of his paycheck in investments every single month. And it would have worked fine if that was just the S&P 500 and S&P 500 index. And he did that every single month of his career and ignored what was going on in the stock market, ignored 2008, and just invested straight through it because he was working and he was just putting a portion of his income away and planning to use it in 15, 20, 30 years. That's a great approach. But he had taken a different approach and he was interested in investing in individual companies. And he was a subscriber to the Motley Fool, and the Motley Fool is a service that recommends, stocks every month. It's similar to what we do at 7investing. The Motley Fool has some more advanced and expensive services, which we keep things very basic at 7investing. We have one single product and we'll get into this, but it's $17 a month, and then you get your monthly recommendations. But the same type of concept, right? And so that's what got me interested in finding individual companies, looking at the underlying businesses, the management teams, trying to find important trends that I think are going to be more important in the future than they are now. And then what companies are leading the way and innovating or disrupting industries or whatever. And the reason I got interested in that was because he had invested like $6,000 in Netflix in whatever it was, 2002, 2003. And by 2013, it was worth like $95,000 or something like that. And all he did was hold on to it. And he had a couple other, similar examples, but that was the most striking one. And so that really got me interested in. And I think, there's a lot of people you have on the channel, and even me now, like I'm studying stocks and the market basically full time. But I think a lot of people that probably watch are maybe not in that position, and they might have a full-time job and they're just trying to, use some extra money and grow income or invest or trade to, be able to pay for a down payment on a house or their kids' college or their own college or whatever. And so that was my thing. Was I had a full-time career. There was no way I had time to pay attention to the market hourly or daily, sometimes even weekly, because as a member of the military and the job I had, I was from 2011 to 2018, I was gone from my house more than 50% of the time. And some of that is on flights, just traveling. Some of it is training out in the desert. Some of that was in the Middle East. And so I didn't always have access to the internet. I had job responsibilities every day, and I just couldn't focus on the market. And so I had to do something that worked with my style and my life. And I guess that's my first message is, whether you watch Richard's channel or you're out there on Twitter or you're following some of the best investors of all time, Warren Buffett, whatever, just realize that nobody's situation is the same as yours. Yeah. And you've got to, you could pick up the best tips and traits from somebody and learn how to find the best stocks. But if you don't apply it in a way that works for your situation in your life, it's very hard to be successful as an investor. And so we just have to have some self-awareness and know where we are and what's going to work for us. So anyways, I'm rambling here, but that was how I got exposed to long-term investing, owning individual companies and trying to own them for years. And it was just because I couldn't do anything else. And I wanted a way to grow my money, and it worked well. I mean, from 2013 to 2018, I was able to, or really 2017, I was able to just invest every single month and grow a portfolio of both Roth IRAs, self-directed Roth IRAs, which are retirement accounts. Mm-hmm. And then after I was able to fortunately max those out, and my wife as well, it's kind of a joint thing. The rest we kind of put into just a non-tax advantage joint brokerage account, and did the same thing, put the same in there every single month, and then own stocks. And the purpose of that difference there was that, and I'm not a tax professional, so this is not advice, but the retirement accounts were for after 59 and a half. The joint brokerage for me was the gap. And this is what I'm talking about invest in a way that works for you. That joint brokerage, I looked at that from basically like 10 years to 30 or 40 years before I drew from my Roth IRA. And that's still kind of how I look at it.
Right.
But what that joint brokerage allowed me to do was, over a period of 7 years, was we got to a place where we had enough that I was comfortable making the transition from the military into the civilian world with a lot of unknowns, not knowing if I was going to be able to get a job and what. And the reason we did that was just because I talked about how much I was gone. I wanted to spend more time with family. Right. But my interest in the stock market and business and investing in doing like the fundamental analysis of companies actually helped me get a job as a business and technology consultant at a company called Slalom Consulting in 2000. I did that from 2018 to 2019. Mm-hmm. And that's when I got very interested in enterprise software, right. Software as a service stocks, things like that, because my job was to help some of these big businesses do Salesforce implementations, Workday implementations. I saw them trying to replace their like Oracle databases with MongoDB, unstructured databases. And so I just got to see some of the most well-respected and largest, most successful businesses in the world, how outdated some of the technology they were using and how mm-hmm. long it took to replace some of their on-premise and old legacy software and licenses with cloud services and sort of like the way that they're building new things and how they're developing these new products. And so even I can't really share their names because they were customers of Slalom, but some of the businesses that you see out there today that are some of the largest businesses in America, I was just amazed that even in 2017, 2018, how outdated some of their stuff was. And even now they're still just in the early days of transitioning to, some of these new cloud services. And so that's what got me really interested in the cloud and software as a service types of companies. I saw it every day. And then I started looking at, okay, well, this company, Alteryx, that I see, Slalom is a partner with, and I see them doing a lot of data analytics projects with some of their customers. What does that business look like? How can I learn from that business now that I've seen the product, and is it a good investment? And it turns out it was. I bought Alteryx in 2017, 2018, and still own some today, and held it for a larger position for a long time. And it was a huge winner. And so that's my style. And that's my approach to investing. I look for important trends in business and in the world. And then I try to find the businesses that are leading the way and that are going to be more important and more meaningful later than they are now.
That's awesome. And are there any, outside the Motley Fool, what type of resources allowed you to kind of learn for yourself about this? Were there any books especially that have helped you along the way?
I haven't, I mean, I really don't read a lot of investing books. I mean, I've read like One Up on Wall Street, and I've read a couple things from Warren Buffett. I more orient towards like articles and blog posts, and what I love to read are things like the Amazon annual letters and annual letters from businesses that I think are, and investors that are good investors. Even Howard Marks does annual letters. But just things like that. But really it's like, there's no single book or single annual letter or single style that I've looked at and I'm like, oh, I'm going to do exactly that. I just look at them and try to learn from Amazon and Jeff Bezos and even Warren Buffett's annual letters. How do these people think about the business, and how, like, the biggest takeaway I have from Amazon's annual letters and Warren Buffett's annual letters is they almost completely ignore what they think is going to happen to the economy. And they just run their businesses in the best way that they possibly can for the long term. And if they have that mindset and they've got enough cash and they've got enough sticky services and income coming in for Amazon through like AWS, they're going to be able to withstand downtrends in the economy in 2007, 2008. Yes, their stock price was going to get hit, but what mattered more was, is their business going to survive? And then are they going to be in a place to get stronger through 2007 to 2008, or even now, early 2020 for Amazon and some of the investments that they were able to make and things that they were able to do? Are they going to get stronger through downturns and then 2-3 years from now be better off?
Right.
That's how they run their businesses. And that's the exact same way that I look at my investment portfolio. Is if I have my foundation right, which for me is, I don't invest any money. That the money that I invest is my own money, and it's by far, the most significant part of my family's net wealth. But I look at that as a 10 and 20 year thing.
Yeah.
Not, I'm going to need that money next year or in 2 years. And so any money that we might need in a year or 3 years, I don't have invested. And so an example of this was, we knew that we were going to buy a house we wanted to buy a house in like 2018. Any money that I thought we were going to need for a down payment, I did not have that invested after about 2016. And so what that allows me to do is keep that long-term focus on owning great companies. And, whatever, the coronavirus in 2020 happened, and you can't really predict those things. And for most people, at least in my own experience, if I tried, I would constantly be out of the market. And for me, when I'm investing, the majority of my family's wealth in the stock market, I can't be moving, to 30%, 40%, 50%, 80% cash on a whim. So the way I handle that is I just don't have anything that I'm going to be worried about in the next 3 to 5 years in the market. And that has let me withstand some of these downturns. You didn't even ask that question. You asked what resources I use. Some other great ones that are out there today. So for learning about investing, I think you should watch and listen to everything that 7investing does. We try to talk a lot about how to be a good long-term investor and give people the tools to get started. We've got a free podcast and then a lot of like free information on our website. But then there's some people out there, and Richard, you told me anytime I can share my screen, it's better. So let's just do that. I'm going to share my screen.
Yep. I think I gave you access. So yep, there you go.
Yeah. So Twitter has been a great tool as an investor. It's also a really bad one because there's a lot of people out there talking about a bunch of nonsense and like stocks that are just complete penny stocks and stuff like that. And it's like, you got to know you got to know what you're doing. But I'll share with you, when I say know what you're doing, you have to know who you're reading, and know like if they're doing the same thing as you, and if somebody's trading in and out of stocks, or they're constantly buying and trimming. And if you're a long-term investor and not focused on the market every minute, then I don't really value that type of input. And so Twitter's great, but you got to watch out for,
you want to be following the people who are doing the same kind of style as you, basically.
Right. You can, and that just goes back to like knowing what your style is and
exactly,
and what you're not. So anyways, a couple of people that I would recommend everybody follows, and these are like more oriented towards long-term investing, is Christopher Seifel. He's at Seifel Capital. He does a lot of really good deep dives. He's even got a newsletter about companies and industries and things like that.
Yeah, he just did some really good stuff on AI. I saw his newsletter post about that.
Yes, I love those deep dives that he does, right? Muji at Hypergrowth. If you're interested in tech and SaaS style companies, he's a great one to follow. So he's at Hypergrowth. And through these people and their newsletters, like that is and again, 7investing. I got to say 7investing, I'm biased, obviously. That is the content that if I was getting started today, I mean, I read it all today. I read their stuff today, but if I was getting started today and wanting to learn about these industries, those are the things that I would be reading. And then Stack Investing he's not as active on Twitter. He's on here, but he does awesome analysis through his website of a lot of these, tech companies and cloud companies and things like that. And then, I think so. You'll probably ask about my process. I don't want to go too far, but those are 3 resources I recommend everybody follow. And then of course at 7investing, and here's the team up here. Ton of respect for each of the advisors, and we all kind of focus on different things in different areas of the market. And then we've got on our website, we've got a bunch of free articles, interviews, podcasts, and we talk about how it works in our format. So those are the 4 things, resources that I'll share in terms of like getting started investing.
That's great. And why don't we talk now about kind of how you select a company to invest in, and your kind of process and diving deep into maybe their fundamentals and kind of the different criteria that you look for, and also any potential red flags that might turn you away from a company.
Yeah. And so I think the way I want to frame this, and it's going to seem like I'm trying to push 7investing here, but the reason I'm talking about it is because there's 7 of us at this company, and in terms of the lead advisors, and we're all bought into this style of investing in this process. So this is like literally how we evaluate companies and look at them. And I buy, so we make 1 recommendation a month each for 7investing, and I buy every single one of them. That's where since October, I've been putting my monthly contribution has gone into my 7investing recommendation. I do it the day after it comes out. So the way that I'm going to frame this is I'm just going to share with you the 7 principles that we look for. And this goes into the style and how we evaluate businesses, right? So we talked about this a little bit, but it's personal. And that's just like, we talked about that earlier, but you got to invest in a way that works for you. You want to buy companies, not tickers. So that's looking at the long-term fundamentals of the business. Don't stress yourself out. Again, just making sure you're comfortable with the way you invest. Time is on your side. So you've heard it before, but time in the market, not timing the market. Valuation does matter. So we'll get into that in a little bit, and find one-of-a-kind companies. So what we're really talking about now is how do you find one-of-a-kind companies? And so for 7investing, every month we write a report, and this is putting it in this way, it helps me evaluate and look for companies. So we've got a key takeaway. I want to look at what the company does. Why is the company a good investment? Looking at the bigger picture, some thoughts on valuation. What are the key risks? Management and vision, and then what should investors be watching? And so if we think about it in that context, I already talked about how I look for big emerging trends. And the places that I find some of these big emerging trends, right, is just reading widely. So I subscribe to Feedly, and I spend, a lot of my time just reading and studying different industries and publications to understand what's going on in the world, what's going on in business. And again, like what businesses are doing that. So I don't ever look at any technicals or anything like that. I don't care about if it's above a moving average or below. I could not care less. And so rather than spending time looking at that, I spend time evaluating and just reading and learning about the world, right? And so what Feedly does is it aggregates different publications into a single feed that's pretty quiet and away from a lot of the noise and distraction. And so I follow specific companies. And so you can see over here on the left side, these are the stocks, some of the stocks that I follow. So this is Alteryx, this is Anaplan, this is Okta, Cloudflare, Etsy, Fastly, Mongo Database, PagerDuty, Redfin, Zillow, Spotify, Datadog, Peloton, Twilio, Zoom. So what this does is they all have research blogs and they post research articles and things like that. Anything they post will show up in my feed here. And then I just, see what is going on and what companies are talking about, and then try to learn more about those different areas. And, but then outside of the company research, I've got these are my daily sources. So I guess, again, back to more things that people could read. Wealth of Common Sense is more of just like a finance blog. I just like his approach to finance. Andreessen Horowitz, so they're like a venture capital firm, and they've got podcasts and they talk about a lot of huge trends and huge industries and growing trends. ARK Invest, same thing. They put out all kinds of reports. They even do big ideas of 2020 and 2021. ABC, Beta Technology, Canada. So anyways, I've got all this stuff over here, and I mean, that's how it's kind of like this fluffy thing, right? But I just spend a lot of time reading and understanding these trends. And then once I understand a trend, I'll dive in and try to find companies that are making a difference in that trend. And so with Zoom in 2000, so Zoom IPO'd and it was 2018, I think, or maybe it was 2019, Zoom IPO'd.
I was at that April 19.
Yeah. At that time, I was a career coach at a company called Lambda School. And what we did was I helped software developers basically with resume prep, LinkedIn, and with their job search. Lambda School's entire business at the time, and I'm not there anymore, was basically run off of Slack and Zoom. And so when Zoom was IPOing, I realized the types of businesses that could be built just completely on Zoom alone. Right. And so and then in my mind, I said, okay, the company I'm at is doing that, but what is it, just us, or is this more of is there more to it? Right. And so I did research, and I mean, the way that I do research is I go to the company's website or even the SEC, and you can see their documents. So every company is going to have an investor relations page. It's usually just, if you just Google investor relations, but you can also just go to the homepage and then go to investors. And they've got recent press releases, which is all the recent stuff. But so I'm trying to get back to Zoom's first earnings release ever. So I bought Zoom on the IPO day. It was up 50 or 100% even on the IPO day. But what I want to do, and so I looked at Zoom's S1 and learned about their growth leading up to the IPO and how efficient the business was. And then I understood the trend. I was at Lambda School. I saw what we were doing with it. And I thought that more companies were going to be getting comfortable doing business online. And then, so before Lambda School, I had used, as a consultant, I used Skype a lot.
Yeah.
And it was just terrible. It was a horrible user experience. And so having that background knowledge and seeing the difference between Skype and Zoom, and then using Zoom every day and seeing the scale and how it could grow, I just knew it was a company and an industry that I thought was going to get larger. And the thing against Zoom was everybody said, well, it's just a video conferencing tool, a video collaboration tool. But if you looked at Zoom's numbers, it was clear that and if you listen to Eric Yuan talk, it was clear that they were moving faster. They had a better product and they were growing faster than their competitors. And so when that's happening in a business, I try to take my personal opinion out of it. I think Skype's better. I think Zoom's better, or whatever. And I try to let the management and business results tell me which one's better. And, for a company that was growing as fast as Zoom, and their customers were growing, their revenue was growing, the retention was so high, those trends don't just change in a month or a day. You would start to see a dip in user growth and revenue growth over a period of, multiple quarters or multiple years. And so a lot of people, the narrative around Zoom was like, oh yeah, it's great, but it's just going to all go away. And that doesn't really happen if you're looking at a real business. And so we're back in 2019. This was Zoom's first report as a public company. And so right here is Zoom versus, and this is obviously Zoom slides, so they're going to be biased, but it made sense to me, right? So Zoom, and because this is what I experienced, Zoom was a single easy to use platform. It was 100% cloud native, very high quality of service, good mobile functionality. There was multiple times I had to call into Skype calls and it was just horrible. But then with Zoom, it's super easy. And then developer friendly and open APIs. So this is huge, right? And so this is a key to a lot of a lot of software today, even companies like Twilio and Mongo Database, that they empower people to like build and either connect with other software through APIs on the platform. That's a lot different than what other solutions used to do. So right there, I was like, okay, this is great. I'm bought into that. This is just talking about federal authorization, so they could begin selling to the Department of Defense, and I was familiar with that as well. Through the military, I knew like, hey, it's a major pain in the butt to be able to use different services, so it's a big thing. But almost every company's trying to do that, so it's not a huge deal. But here's what really matters, right? So they were growing, and they gave you information, and I don't remember how their fiscal years worked, but whatever. If you look at these trends, this is their revenue growth in millions, right? So Q1 fiscal year 2018 is 27 million, up to Q2 is 33 million. And so from Q1 fiscal year 18 to Q1 fiscal year 19, it grew from 27 million to $60 million in revenue. That's over 100% growth, right? What I look for with companies is as their revenue grows, it's theoretically going to be harder for them to continue growing at the same rate, because the law of large numbers, it's harder to double 100 million in revenue than it is to double 27 million in revenue, right? So that's very impressive. Over 100% growth from fiscal year Q1 18 to Q1 19. What's even more impressive is when somebody grows from that 60 million in Q1 fiscal year 19 to 122 million, which is 103% growth again after have just growing 100% off a smaller scale. A company that can do that is special. That means that their product is really not just a flash in the pan. And we're talking about a meaningful amount of revenue. We're not talking about $1 million or $2 million or $3 million in revenue. We're talking about hundreds of millions of dollars in revenue here. So revenue growth is something that is one of the most important things that I look for in the companies that I own. And then can they grow that revenue sustainably? So how do you figure out if a company can grow revenue sustainably? it comes down to how they attract customers. Is customer growth also robust, and is customer retention robust? Because that's how they're going to be able to sustain that. And then we'll get into it in a minute, but I want to see companies' marketing spend as a percentage of revenue actually decreasing over time, because what that tells me is that as the company grows, it's getting more well known, and they're probably getting a lot of like organic business, but also probably the most important thing is the customers that sign on with them. Do they stay with them? And then do they spend more every year? Because that takes almost zero marketing spend and zero effort, is to make your current customers more valuable. That's how you find a business that's like firing on all cylinders. And Zoom is a great example of this.
Right.
So their customers with more than 10 employees was up 86%. That's almost growing as fast as their revenue, which is great. And then growth in customers with over $100,000 in trailing 12-month revenue. So customers that spend over $100,000 with Zoom the previous year grew 120%, which was faster than their revenue growth. So that was a really good sign that their larger customers were growing fastest.
Right.
And then with software as a service companies, or enterprise SaaS companies, really it's companies with recurring revenue, so software as a service, net dollar expansion rate. So what that shows is if a customer, how much customers spend with them in following years. So basically, if a customer is with them in Q1 of 2000 fiscal year 19, then by Q1 fiscal year 20, so a year later, they spent 130% of what they spent the year prior. So they're increasing the amount that they spend with Zoom every year. That's a huge metric. And so, they put it on their slide here, but that shows the loyalty and trust that they've earned with their customers. And so basically, that's my process, right? Is I find these trends. I try to identify either products that I've used and interacted with, and I was doing that more when I was a consultant, so it was easier because I was working with these things every day. And now I'm not doing that, but I go back to the reading that I do and the blogs that I follow and the company blogs that I follow to start getting pointed in these directions. And so then I knew that Zoom was a position that a company I was interested in, but when it first IPO'd, I considered it, pretty expensive and pretty risky. Mm-hmm. And so, these are generally, I think this is a question you asked me in the first place, and I went off on this crazy tangent, but in general, I look for companies that are between $1 billion and $50 billion in market cap to start a position. Right. I'll go a little bit beyond 50 billion now because, back when I kind of like set these rules, the largest company was only $1 trillion. And now the largest company is like $1.5 trillion or something ridiculous, almost or $2 trillion. So with that, that just shows scale of business is getting larger, right? So my metrics expand a little bit. I look for revenue that's growing faster than 30% year over year. And these are just general frames, right? Gross margins over 70%. This is mostly for software businesses. And so we can get into why I like, in general, software businesses more than an airline or an auto manufacturer, industrial businesses. Software businesses are great because it almost costs nothing to sell another subscription to the next customer. Right. If you are Ford and you're selling F-150s, you might have the most popular F-150 or most popular truck in America for 20 years straight or whatever it is. But in order to sell another one, you've got to put all the money into running the plant to build it, manufacturing it, having the people manufacture it, and then selling it. And then there's the risk of you've got to maintain levels of inventory. And if you can't sell that thing, then what are you going to do with it? And so they take a lot of capital expenditures and reinvestment just to produce the product. Software companies are great in my opinion. And I don't just own all software companies. There are some that are too expensive and overvalued and things like that. So I do look at valuation. But software companies are great because they can invest that money that they would have had to invest in just creating the next truck. They could put that in R&D, or they could put it in marketing, or they could put it in stock-based compensation, or mergers and acquisition, or just any number of different things that they think are going to help them invent the next product and release a new product to grow their total addressable market.
Right.
DocuSign's a great one. They started with just doing documents, and now they've moved into doing like not notary stuff, but it's escaping me, but moving to like more real estate documents and things like that.
Right.
The term is escaping me. But just as an example, they've expanded their product portfolio a lot. Even Zoom has gone from just video, which we're on now, to Zoom phone, and even some hardware and different features and things like that. I want to see decreasing marketing spend as a percentage of annual revenue. We talked about that. That's a sign that their product is great. Increasing annual operating income and increasing annual free cash flow. And then I think about investments in this way, right? I kind of have like 3 tiers. Tier 1 companies are companies that I personally am comfortable starting an 8 to 10% position. And that's like with my own cost basis of my portfolio, right? And my target for those would be like a 3x to 5x in 5 years. And so these are just like some of those types of companies. And so these are just in here as examples, but Etsy, Mercado Libre, Teledoc, Twilio, CrowdStrike, Peloton, Roku, those are the types of companies that, and I've owned these companies. These aren't just, there's a lot of people that own all of these companies now. These are companies that I've owned since 2018, 2019. And so for multiple years. And now, in a lot of cases, I'm not adding to these companies now because they're up 300-400% or whatever, but I'm not selling them either. And I'll talk about selling in a minute. But I like to have about 60% of my cost basis in tier 1 companies.
Right.
And then tier 2 companies will be about 30%. And those are starting positions of 3 to 5% each. And so the target for those is I look for like higher upside, but there's also higher risk. So that's why I'm putting 3 to 5% in them versus 8 to 10%. And then with 10%, those are kind of like the home run, the moonshots, right? I'll put about 10% of my portfolio in them. These are tier 3 companies. They're companies that I think are in huge industries with huge potential, but maybe unproven and a lot of risk. And so those will be about 1 to 2% positions each. And then this is crazy. 50x to 100x in 5 to 10 years. Those numbers could be off. Who cares? The point is that they're businesses that I could see 25xing, 50xing, 100xing if given enough time, but there's a ton of risk. So I'm not going to make it a 10% position. I'm going to make it a 1 to 2% position, so that if it does become a 25x or a 50x or a 100x, then that 1% turns into 10%, 15%, 20%, whatever. But if it goes to 0, then it's not going to kill me. And so a company can move from the tier 3 to tier 2 to tier 1. It could also move from tier 1 to tier 2 to tier 3. But generally, if that starts to happen, if I lose faith in a company, I'd almost just get rid of it and move on versus like trying to hang in there because there's some things there. And so I'll give an example. Twilio, I owned Twilio in 2017 and owned it for a long time. And I don't know, had a 4x, 5x, whatever. And in 2000, I believe it was like 2019 to late 2018, 2019, they acquired SendGrid. And I thought that was great. But I really didn't like the way that management was talking about their growth. And they didn't do anything illegal. Jeff Lawson didn't do anything illegal, but he just wasn't as clear and transparent. And so what Twilio was reporting was like 70 to 80% growth. And it was about 35 to 40% organic growth. And then with the SendGrid acquisition, it was 70 or 80%.
Right.
They broke that out obviously in their quarterly filings, but he just wasn't as upfront talking about it as I would have liked him to be. And at the time, Twilio was like my largest position. And so management is really important to me, and integrity of management. And I just felt like I lost faith in the integrity of management. Not that I'm calling Jeff Lawson a liar or whatever, but when you own these companies and it's your own money, like you want to be confident in them, right?
Right.
And so I sold Twilio, and it wasn't because the stock went down or anything like that. It was because I lost faith in management. And so I spent some time reflecting and thinking. And then early on in this year, when the pandemic happened and businesses, the whole world changed, really it did. And I think it changed forever. Not saying we're going to be like completely work from home forever, but there's trends that the pandemic accelerated and put in place that are just not going to be stopped now. And they're just going to pick up momentum.
Right.
And one of those trends was all of the restaurants in our local community shut down, right? And I'm sure everywhere, and you couldn't go sit there, but you could order from these restaurants and then either do takeout or delivery or whatever. And in almost every single one of them, you put your order in and then you would get like SMS text updates on where the order is and what's going on. And that's exactly the type of thing that Twilio does, right? Is they are like the communication level for software, and they integrate software and help basically software communicate with each other. And one of the things they do is those SMS push notifications. And I don't know if every restaurant I used Twilio necessarily, but I know that Twilio is a leader in that category.
Right.
And I saw that happening more and more. And I know for a fact that that's not going to just go away after this. Like people are now used to it. And so it's going to continue. And so throughout, like during the pandemic, I bought back into Twilio. Now it's a 8 to 10% position again. And you cut me off if I'm going too far, but the other thing I really like about Twilio is, this year they've come out with, it's called Twilio Frontline, which is like programmable video. And so the idea with Twilio Frontline is that if a retail customer or a retail associate is in the store and they're talking to a customer through WhatsApp or something like that, they could basically have it connected to where they can start up like a real-time video call with the customer and do customer service that way. Or people that are influencers out there could have like real-time video streaming and then interact with customers that way. That's like the vision of this product over time. And so the point is that back to the innovation thing and staying leaders and releasing new products, Twilio has continued to do that. And I'm excited about the products that they've been able to release during this crazy time that's a pandemic, to support, their business.
Right.
So I just rambled a lot. Get me back on track here.
No, that was great. It's so interesting to see how you go ahead, and I love this because I actually look at the exact same stuff. I want accelerating revenue, great earnings. Usually smaller companies are better. And these names that you gave as examples for your basically your tiers, I focus on those exact same names based on my own method. So we might have different time frames, but we're looking at the same disruptive type of companies. One thing I did want to ask you is, how do you look at valuation in terms of, do you use the PE ratio? Do you use price for sales? Do you use any of those ratios to look at companies, basically what you think their market cap can be compared to what it is today?
Yeah, great question. Let me hit on this real quick. And so I talked about those tiers, right? And one of the things that is kind of common narrative, right, is it's like, okay, if you owned Amazon in 1999, there's no way you would still own it today. You would have gotten scared out of it, or you would have never profited that much from it, blah, blah, blah. Like the narrative against that is that people say that you would never be able to actually hold a company through all of that, right?
Mm-hmm.
This goes back to like trying to set yourself up to be a successful investor for what you know how to do and what you're comfortable with. The way that I'm trying to set myself up to be able to hold the best companies in the world that will give you generational wealth is by putting frameworks in place that allow me to hold them. And so a tier one company, I might put 8 to 10% position of my portfolio in it, but I'll let it grow to 20%. If it gets beyond 20% of my portfolio, well, then I'll trim it, and I'll trim it back down to 20 or 15%. But I'm not going to I'm not perfect at this. So like, I'm also like, I need to improve. Like we all need to improve, but this is my process. Right. And if I was perfect, I would do this. So this is what I strive to do. Perfect in my opinion. Everybody's got a different opinion of perfect, but is the max threshold is 20%. If it gets beyond that, then I don't want to sell a business that is obviously doing well and growing, because as we've seen with Amazon and Netflix and Google and all the greatest companies with our time, usually the best companies tend to get better.
Right.
And if they're getting better because the stock is, or the fundamental business is performing well, so the stock price is increasing, then in my opinion, it's likely that they're going to keep getting better with time, because what that means is that their business is growing, their revenue is growing. They have more money to invest in releasing new products. They have more money to hire and attract the best people. They're doing exciting work, so they're going to attract talent. There's a lot of reasons why the underlying businesses of companies that are doing really well tend to get better, and the strongest get stronger and weaker get weaker, because the stronger take the talent from weaker. It's just like sports teams in life, right? Mm-hmm. So I don't want to sell a company just because it's up. I own Roku. I don't want to sell Roku just because it's up 400% or whatever. But I don't want to let that become too large of a position of my portfolio to where I can't sleep at night. So what I've noticed is that 20% is about as comfortable as I'm going to be. That's as high as I can be comfortable. Tier 2 companies, remember, these have a higher risk than, in my opinion, than the tier 1 companies. So if a company is still a tier 2 company, I'm not going to let it get much beyond a 10% position. Now, for example, Fastly and Fiverr are two companies that I'm more and more comfortable with. And Fastly, so here's another example. Fastly used to be tier 1 for me, but because there's been a lot of questions around TikTok, and have they lost TikTok? Have they, and not just TikTok, but are they going to lose other customers? Because TikTok, I'm not too worried about, but if they were to lose more customers, Fastly has temporarily moved down to a tier 2 company, where I still believe in the underlying future of the business and the trends and everything like that. But I'm not going to keep adding to it here. The position I have is large enough. I'm going to keep it and then let the business either decide if it moves back into tier 1, stays tier 2, or whatever. But say Fastly became a 15% position, and all of this political stuff with TikTok and their customers goes away, and everything gets back on track exactly the way it was trending. It could move back up into tier 1, and then I would let it grow to 20%.
Right.
So that's kind of how I let these tiers work. And then with tier 3, they're still really risking. They could be moonshots. But if it gets to a 5% position, that's a 600% return potentially. I'm going to trim it a little bit if it's still just as risky as it was before. And that's just a framework that helps me own some of these great companies, stay invested in winners, but also not let my portfolio get out of control into where I'm not comfortable.
Makes sense. And how important do you think it is? Sorry to interrupt. I just want to ask this: how important do you think it is for somebody to have a system like this, where you can write it down on one sheet of paper and keep it simple?
Yeah, good question. Again, it goes back to like where we are as investors, right? So this has evolved for me. I started as an investor, and so now, through this allocation, you can see that if you look at this, I would probably own 15 to 20, maybe 25 companies max. Mm-hmm. Really, it's like between 15 and 20 for me. But this has evolved over time, right? So you got to grow into what works for you. I think this is important to start to think about and grow into. But one of the things I love about 7investing is that we recommend 7 companies a month. And then, and so my approach when I was working full time and had other things going on than just looking at the stock market and going deep on all these companies, is if I was a subscriber to 7investing, I would, look at the advisor, whatever advisor I related to and the types of companies, and read their reports. And then with my monthly contributions, and I'm just speaking my own self and how, a service like 7investing worked for me when I didn't have time to just watch the market all the time. And I would just put the same amount every month in, like, I split my monthly contribution in two, and then I would buy two of the companies every month with the same amount. And so then my system isn't as evolved to where I'm deciding which company I like better and putting 10% of my portfolio in that, because, that's a great approach for somebody that's in year 1 through 5 of growing their portfolio, where your monthly contributions are still like a pretty big part of your portfolio. And annually it makes up like, whatever, 10, 15, 20% of your portfolio is your monthly contributions. At that point, I'm comfortable just putting the same amount in every company. And then if I really like a company again next year or whatever, then I'll do another monthly allocation to that company. So that's kind of like the way that I built that was my investing journey, was I started doing that. And then once my portfolio got to where my annual contributions, what I added was like less than, say, 10% of my portfolio, that's when I started to think about, all right, what size position am I comfortable with this being? What are my tiers? How do I think about that with risk? Because I didn't have as much chance to make up for mistakes using my monthly contributions. If say I owned Virgin Galactic and I owned that early, and then it became 30% of my portfolio or whatever, and it was a really risky company, I wouldn't want that at that point. I would want to trim it down. So that's kind of how I think about it. Depending on my phase as an investor and where I'm at with building my portfolio, I would potentially just add the same amount to each company that I like and do some research, and then not really think about it much more than that, other than pay attention to, you don't even have to, if that's you as an investor, you don't even have to watch quarterly reports. If you have a life and you're out there working, the best thing that I did was I just split those up evenly. I owned 20 to 30 companies, and I would check in with them, every 6 months or once a year or whatever. Or the service I was following, like 7investing, we will do like a sell report if we're not in the business. So I just put trust in that, right? But now, so let's say you want to spend some more time with investing. You have a little bit more time to look at it. You're comfortable. You've learned what you like, your style. I think it's very important to have a framework to help orient yourself around companies. And so, as an investor, one thing that Chamath Palihapitiya out there on Twitter has been sharing his one-pagers of the companies that he's doing the special acquisition companies for. And so one of the things I'm trying to actually adopt is starting to do one-pagers on my position. And this is 2 pages just because I messed up the formatting, but really this is a one-pager. If this was up here, it'd be a one-pager. I just pasted it in here. Why are these great? These are great because only having one page is enough space to have a full train of thought, but it's not too much space to where you can ramble on and have a super complicated thing. So, I highly recommend a one-pager. I shared this out on Twitter, and Chamath has shared them. So if you follow me on Twitter, you can find this one-pager. Richard, you could probably link to it in the video. And the way I did it was I kind of just have a summary up here, which is why, and I think BioLife is a picks and shovels provider that benefits from the exponential upside of the regenerative medicine industry. So back to that industry thing, right? Like, what are these industries that are growing? It's expected to grow from 35 billion in 2019 to 124 by 25. And I think I got that from ARK Invest in one of their research reports, which I should have cited right there, but that they did on the genomics industry.
Right.
And then industry catalysts, what is the company specific thesis? And then what are the key risks?
Right.
So yeah, rein me in, Richard, rein me in.
Right. Bring us back to the price PE ratio and price per sale. Do you look at those metrics at all?
Yeah. And so with considering valuation and how I think about that.
Right.
We're at a place in the market now where it's like valuations I'm a very bullish person on the software industry. And even I am amazed at where valuations have gone on some businesses. So I am a little bit more cautious on valuation now. And there's a lot of what I believe are not great businesses that are just insane. Like you'll see a one day pop, like GameStop or whatever. And I have not even looked deeply into GameStop, but I saw something that there's a Wall Street's bets thread on GameStop, and like there was some type of coordinated thing potentially to advance the stock or whatever. I'm not saying that is the only reason GameStop went up, but the point is that there's things like that are going on out there, and so I'm just cautious on some of these companies that I'm not confident in the underlying business, that are making these ridiculous moves and have these ridiculous valuations. The other thing is, like, I love people making money in investments, and that's great, but I am not going to own every company that's out there shooting up 50% in a day and 100% in a day or whatever. Like, and I'm fine with that. I invest for myself and for my family, and I want to invest again in a way that I can live my life and be a good dad and all those things, right? And that means I'm going to miss some of these crazy returns and stuff like that, because I'm just going to own the boring companies that only go up 200% in a year and not 500% or whatever.
Only 200%.
I know 200. It's ridiculous, right? Okay. So anyways, so this is Ycharts. You do not have to use Ycharts. It's an amazing tool, but like, you don't have to use Ycharts to be an investor, right? But we're talking about it. So I'm going to share with you kind of the things I look at, right? And these are some of those metrics I talked about, right? Revenue, quarterly year-over-year revenue growth, trailing 12-month revenue. I look at trailing 12-month revenue in relation to quarterly year-over-year revenue growth, because it goes back to, is this a real business? Mm-hmm. And Zoom's growing quarterly revenue 366% year-over-year on $2 billion in trailing 12 months revenue. Holy cow, that's incredible. And then you look at even... So Teledoc is growing at 109%, which is great, but it's on 867 million. That's still fantastic. And Teledoc is a very real business. I have companies I'm interested in as core positions here. So these are all what I consider like pretty good businesses. I have need to research. So let's look for one that is growing fast. Okay. So FUTU, right? They're growing revenue at 318% according to this. I don't even know if it's 100% accurate, but I bet if we look at their trailing 12-month revenue, it's only $244 million. So, not a penny stock per se, but that's a lot different than
a Zoom. Yeah.
Than Zoom. Growing 366% on $1.9 billion in revenue. And so, how does this all play into price of sales and valuation, right? So again, their gross profit margin is 70%, right? So that means that revenue that they're getting is they're able to, and gross margin doesn't go directly to profitability. Their businesses can have high gross margin and not be profitable because it depends on other underlying fundamentals in the business. But the point is that they can be profitable based on the margins that they get from the product they're selling, if it's as high as 70%. So that means that $2 billion in revenue for Zoom is much more valuable than $2 billion in revenue for Ford, who has a gross profit margin of 16%.
They have way more overhead. Yeah.
Yeah. So that revenue, and so this plays into valuation. That revenue is much more meaningful for Zoom, and they can do a lot more to grow the business with that revenue. So I'm willing to pay a higher price to sales ratio for a company like Zoom that's able to grow 366% with $2 billion in revenue and 70% gross profit margin. And oh, by the way, Zoom is a profitable company. And so if we look at whoops, I messed this up. If we look at their price to sales ratio, their forward 1 year price to sales ratio is 31, right? Well, Zoom is not going to grow their revenue 366% next year. But if they could just have no growth and and have the same amount of revenue next year that they had this year. So $2 billion in trailing 12-month revenue at this time next year. Well, their price to sales ratio would be, I think it would cut in half. I'm not 100% sure I'm doing the math in my head, but I think that's how that would work, is their price to sales ratio would be, if their stock didn't move, that would cut the price to sales ratio in half.
Mm-hmm.
And then if Zoom, so the next year, if Zoom actually decelerated and they only brought in 50% of the revenue that they did, so they would be at $4 billion of revenue next year. If they only brought in $2 billion, then 2 years from now, they would have $6 billion in trailing 12-month revenue, right? And their price to sales ratio, if the stock price didn't move, would be somewhere around, I don't know, 12 or 14 or something like that.
Mm-hmm.
And so in that situation, you get to a place where Zoom then, so to me, Zoom is a very low risk investment right now because of the underlying fundamentals of the business, the trend that they're in, and the growth that we're seeing at scale from them, and they're still releasing new products. If the stock price goes down or doesn't move, it's hard for me to see 3 years from now, Zoom's price being lower than it is today because of how fast the underlying business is growing. And in my opinion, we just talked through like one of the worst possible case scenarios for Zoom. A better scenario could be if Zoom doesn't grow at all next year and then doesn't grow at all the year after, or maybe grows 10% or 20% or whatever. And again, that's okay because they just grew 400% or 355%. So they're not going to be able to match that growth. In a normal year, I wouldn't want to see revenue deceleration like that. But 2020 is an interesting year because it's going to make comparables almost impossible. So I do look at price to sales ratio, but I don't let it stop me from owning a company, or I try not to. Because let me tell you, two companies that I have let it stop me, right, is Shopify. So I owned Shopify and I sold it. And so so I don't want to lose anybody here, but one of the things that you can do with Ycharts is you can use this to look at different things, right? So just bear with me. Okay, so we're looking at year-over-year quarterly revenue growth. We're going to look at revenue, so trailing 12-month revenue, and then we're going to look at price to sales ratio, right? And let's take, so now we can do a, try this new design here. And so this has them all on one, right? So I want to get them, I want to do a panel per financial metric. So this is split them all up. And then what you can do with Ycharts is you can show the min, max, and average of each of these metrics. So this is going to show the min, max, and average price to sales ratio. And so what you'll see, and let's go 3 years. So I'll tell you when I owned Zoom, or when I owned Shopify, right? That was more than 3 years ago. I owned Shopify at like $40 a share. I had 200 shares and I sold it when it had gotten to like 70 or 80, right? So this is back in 2016 or 2017 timeframe, right? Why did I sell it? Well, I thought that the price to sales ratio was too high. So we're looking at the price of the stock right here. So if we go down to price to sales ratio, their price to sales ratio had gone from, we'll say, I don't know, 10 in 2016, October 2016, up to, 15, even up to, we'll say up to 20.
Right.
And I felt like their price to sales ratio was too high and it was too risky at that point. Well, since then, the stock price has gone from 90 to 1,227, right? And so the reason, and so this is how I think about price to sales ratio. Back then, we'll go to when it was like 20. Shopify's market cap was $11.75 billion. And so the whole point of that is they were in a huge industry. They're in the e-commerce industry. And a company that's early on in an industry with that much growth potential, and we saw the growth potential in e-commerce through a company called Amazon, right? Obviously, there was a lot there. And this is an adjustment I'm making, I'm much more willing to own a company at a higher price to sales ratio back then, because Shopify's price to sales ratio could have been 5 times what it was back in 2017. If you just own the stock, you have a life-changing return today. So that's a lot of room for error. So the point is that if you have a great company with great management, Toby Lutke is a great CEO, and I felt that, back then even, and they're in a huge industry, I'm willing to pay more on an expensive stock or a price to sales ratio early in their journey than later. I have zero interest in owning Shopify now, because Shopify is a $150 billion company, and they're almost at an all-time high price to sales ratio of themselves of 59. I struggle to see enough risk reward in owning Shopify here over the next 5 to 10 years. And this is just my personal thoughts, at a price to sales ratio of 60 and a market cap of $150 billion. I don't want to own Shopify here when I could own Zoom at that's growing much faster. So Shopify is growing at 100%. Zoom was growing at 366%. And Zoom has a 30 forward price to sales ratio, and Shopify has a 30 forward price to sales ratio. Right. So I would rather own Shopify that's growing basically 3 times as fast than Zoom than Shopify. And so it's kind of long-winded, right? But that's how I think about price to sales ratio is it matters what industry they're in. It matters what the business is, the underlying business. And then it matters compared to other businesses out there, right? And so, just interrupt me.
No, that makes sense. And could you bring up Zoom? Because I remember seeing you on Twitter saying you actually sold your shares back when it was up near 600, and now you're starting to get interested in it. And I actually just started a position a few days ago after it looks maybe to be forming the bottom of the base here. So it's interesting to hear your process in terms of both selling that position and now once again you're looking potentially to get back in.
Yeah. And so just to show you, so back in April, I added a bunch of Zoom at around 120, and I thought we could see 200 plus. So this was when the information came out about how many users they added to the platform. And this was actually a confusing metric because they said users at first, but really it was meeting participants. And so the same user could be they could go to multiple meetings the same day, but still it showed the use of the platform. So the way I thought about valuation then was in December 2019, they had 10 million users and $188 million in revenue with 130% net expansion. I just did this like back of the napkin, really. So if you were to cut current user spend to 75% instead of 130, which I didn't think would happen, I just wanted to be conservative. That meant that that would be $141 million in revenue. Then if you add 190 million users and you cut it and cut revenue per 10 million users to 14 million from 188 million, so like 1/10 of what they were spending, then their Q1 2021 revenue would have been $407 million. And, but then I said, if that was a conservative forecast, what if we keep the 75% user spend? So it's 141 million, but then make new users were 28 million per 10 million users. Then in Q1 2021, they would have 673 million, which would be 250% revenue growth. And then I said that I thought they were going to monetize better than that. But previous, I had shared that I thought they were outrageously valued at $150 a share. So this just goes to show, like, that was my own thoughts, but then I saw the numbers and then I did the math. So that's kind of key to being an investor, right? And so then I said their Q1 21 revenue could be, so it ended up coming in at 328 million. It was up 169%. And then they guided for 221 million or quarter two revenue of 500 million.
Right.
And blah, blah. So I talked about it, and I thought that it could be at 400 per share by the end of the year. And that was just looking at the business and then the valuation. And so with Zoom, if we go back to the fundamental chart, right, and we look at,
and while you're typing, so do you look at PE ratio at all, or it's not really a factor?
So not really for the type of companies that I own, because a lot of them aren't profitable, and so the PE ratio doesn't really matter. But I do look at whether or not these companies are on their way to being profitable and being more profitable. And again, gross margin points out what the potential profitability of the business could be based on the product that they're selling.
Right.
And then operating margin, net income is actually like the profitability of the business after you take out expenses. And so Zoom was a perfect example. They were unprofitable, but then they basically accidentally became profitable because of how insane their revenue growth was. And so I don't care about PE ratio for SaaS businesses because of their recurring revenue model. And a lot of them are reinvesting. Like Amazon for the longest time wasn't profitable, and that was a knock against it. But they weren't profitable because they were intentionally reinvesting their revenues to grow the business.
Right.
Same deal. Okay. So here's why I sold Zoom. And I forget, it was I sold around $550 or $600 a share, $560 a share. This is right around when I sold it. Right. And I'm not like calling myself a champion because I nailed this, right? I just want to share like why I thought about it this way. So Zoom's stock price was at $560 a year. I talked about how I want to own businesses for years, right? Well, Zoom's 10-year thesis has had to played out for me as a shareholder. So I felt like I'm a long-term investor, but my 10-year expectations for the return that I would ever get played out. So I was willing to let myself be a little bit more active there. But more important than the stock price, their market cap had grown to $161 billion. And, when their trailing 12-month revenue is 1.3 billion, right? Well, Amazon, for reference, Zoom had a market cap of $140 billion, and Amazon had a market cap of 1.65 trillion. Zoom had trailing 12-month revenue of 1.37 billion. So basically Amazon's market cap was 10x Zoom's. Amazon's trailing 12-month revenue was 30x Zoom's. And Amazon was at the time, basically the largest company in the world, or one of the largest companies in the world. And then Zoom's revenue growth was, yes, it was 355% a year. But again, they're not going to sustain growing at 355% a year. They're still going to grow revenue great, right? But not that much. And Amazon is not growing slow. They're growing at 37%. So a couple things. Amazon's gross margins are lower, of course, all those things. But just when we think about the scale and the total potential for Zoom's business, I could see it being $1 trillion business. But it was much harder for me to, as an investor who owns a limited amount of companies. And so if I was early on and I was just owning the same amount of each company, I probably would have just left Zoom alone and because it would be a normal portion of my portfolio. But because I have a concentrated approach, and Zoom was a core position at the time, so one of those 10% plus positions, right? I couldn't justify holding on to it when it was a $150 billion valuation, and it was much harder. So a 10x from there is 1.5 trillion. And there was just other things that interested me at the time. This is way back in October when all the ridiculousness of the last 3 months hadn't happened. For example, CrowdStrike was, I actually bought CrowdStrike with the proceeds from selling Zoom. And so if you look at the two, since then, CrowdStrike has been incredible, right? And so that's not me. That's just me looking at CrowdStrike and the size of the business and the revenue growth compared to Zoom and what it could potentially grow into, and just saying, okay, it's easier for me to see CrowdStrike 5xing or 10xing from here than Zoom. And so that's why I did what I did. But now And so let's take Amazon out, and we'll go back to price and forward price sales ratio, right? And so share price doesn't even matter. Honestly, the share price doesn't even matter because what I look at more is just the market cap of the business. I did not sell Zoom because it was the share price was $550. I sold it because the market cap and what I believe the business could grow into wasn't as attractive as it used to be.
Right.
So it was 161 billion, and with a 46 forward price to sales ratio, but now it's down. It's down, however many percent.
About 40% from its high, I think.
Bad at math, you can see. That's the other reason I like Ycharts is I have a criminal justice major, so you don't have to study the stock market to be a good investor. Or you do, but you don't have to have a finance degree is what I'm saying. So now it's $100 billion valuation, and the forward price to sales ratio has come down to 30. So that's down by, 30, 40, 45%. And so, but even a 10x from here is $1 trillion versus 1.5 or 1.6 trillion. So right. It's become a much more attractive business, especially, and this is all relative, right? Especially compared to a lot of those other companies that I was really interested in have now just gone ridiculous, and Zoom hasn't really done anything. So it's much more attractive. And I think, I don't make predictions really, but I just think about things as an investor. I think 2021, 2022 is not going to be as good for the stock market and the types of companies I own. So I think things are going to stabilize and normalize a little bit. And Zoom is a business that I think could give a 15, 20, 30% return in 2020 and 2021, or I'm sorry, 2021 and 22, which, back before 2020, a 15 and 20% return from a stock was amazing, right? So I like that. It's a much more attractive company. And then not just these numbers, right? But the whole story has to line up, right? So if you go back to Zoom and so this is why, in addition to the numbers making sense, this is why I'm interested in Zoom again. Zoom and what's going on in the business and their innovation and new products has to align with those numbers and the data points that I look at in Ycharts, because data is backwards looking, right? Talked about how good companies tend to get better, but the data shows you, what their product has done and what their business has done in the past. That's what Ycharts shows you. The other part, the qualitative part of investing for me, this is all that reading that I went back to in Feedly and all that soft, mushy stuff that I don't have a good process for wrapped up. That's the future for me. And so what I liked about Zoom was at Zoomtopia, and this is their year in review. And so they wrote this on their blog. And so it came into my Feedly and I read it and saw it. They released a bunch of new products. And so just a high level, I know we got to get wrapped up, Richard. They released Zoom apps. So that's going to bring best of breed apps directly to the Zoom experience for use before, during, and after. And if you remember, when I first started talking about Zoom, and in their very first earnings report as a company, they talked about how they're an open platform that people can build on. Well, now a year and a half later, they're still showing that, and they've been working, and they just released this thing, Zoom for Home, allowing remote workers on Zoom, which is a virtual events marketplace. Even when we go back to having events in person, you got to believe, why wouldn't companies and concerts and sports leagues, why wouldn't they open up a marketplace on Zoom so that or an event on Zoom or whatever, so that people can attend from home if they can't come in person?
Right.
Zoom 5.0, end-to-end encryption. So they released a bunch of new products that showed me they're still innovating. They've got Zoom Phone that's expanding. They just announced that Zoom Phone has 1 million seats. I think if you go A Million Reasons to Celebrate Zoom Phone. So this is why I follow these company blogs, is because that's how they update investors. And then also on Twitter, man, I'm all over the place. So just stop me, but use the tools that you have on Twitter, right? So Twitter is, you can do lists, right? And so, on lists, I've created, different things, different companies I own, different types of things. but public founder-led companies. So you can either make specific company lists, or I just went public founder-led companies, and then I can make notifications on this list, or I can actually follow this list in Feedly and then get updates from all of these companies and stay up to date that way, because CEOs are getting more and more active that way. I know we got to wrap up, but there's one other thing I want to talk about. So again, following companies, right? One of the ways I got turned on to Zoom as an investment was from Okta's Business at Work 2020 list. So there's a number of reports that come out from companies in different industries. The Deloitte does Fast 500. This is the fastest 500 companies growing in America, private and public. But Okta does Business at Work, and they use the data from all of their customers to show key findings. And so the most popular apps of 2019. So this was 2019, before the pandemic, right? And so if you look at,
oh, that's cool.
Most popular apps by number of customers, Microsoft Office 365. Okay, you can't invest directly in Microsoft Office 365. Microsoft's a massive company. That's just a small part of the whole company. Salesforce, Amazon Web Services, again, great company, but huge product. Google Suite, Atlassian. So there's a potential company idea. Slack, Zoom, Box, SAP Concur. So anyways, the point is there's, by following businesses and knowing what you're interested in, and Okta is a leader in identity management. They have a lot of the most innovative companies as customers, and they produce this great Business at Work 2020 report that tells you all the trends. I talked about those trends that I look for. They talk about all those trends, most popular apps by number of monthly active users, data and security tools. So this is before Snowflake was public. You could see that. Ops Genie, I think, is a tool of Atlassian. So just, you can probably tell by how excited I am. I just love reading about trends and technology and different companies. My process is really about having the foundation right to where I'm managing my personal finances in a way that allows me to stay invested with the money that I do invest.
Right.
Don't use margin. I look to be a long-term investor. I know my style, and then I have set these frameworks in place. I know generally what I look for. I have my target allocation and these rules that I try to set in place to try to help me be a long-term investor. And then I just try to read a lot. And then once I've read a lot and I think I'm interested in a company, and try this yourself, do a one-pager on it and see if you have an investment thesis. And then just keep reading and learning, and don't be scared to sell a company if you lose faith in it. But the biggest mistakes I've made is, especially if you're not over allocated in a company, is selling a company too soon. I sold Twilio too soon, but bought back, but Shopify too soon. That was a multi-$100,000 mistake.
Right.
So I could lose much more by selling Shopify too soon, as long as it's a reasonable portion of my portfolio, than by holding Shopify and it dropping by 30% or 40% temporary. Shopify is not going to go out of business, right? But sure, it could have a 30% pullback or something like that. But if I owned a 10% position today, and I loved it and I thought it was a great business, I'm probably not going to sell it because I'm afraid of a 30% pullback when it has probably grown from a 2% position to a 10% position, if that makes sense. So, yeah. Is there anything we missed, Richard? I rambled a lot.
No,
I think helpful.
No, it absolutely was helpful. And it's great to see a more longer term focus, because what I liked about this is we're looking at the exact same companies, disruptors, stocks that are performing and is showing up in the fundamentals. But we just have different timeframes. And like you said, it's a very personal choice. Not everybody has the time to watch a screen every day, and you found what works for you. And I think that's one of my biggest takeaways is, and what people watching should take away. Find something that works for you, makes sense, and ideally is profitable. And yeah, just focus on that style and keep doing it. And this is why I'm happy to be one of the partners with 7investing, because I like their approach. I like how they're focused on education and also keep it low cost, which I really appreciate. So yeah, thanks for coming on, Austin.
Yeah. And it's okay to do a little bit of both, right? If you are a long-term investor, I've used options, I've done shorter term stuff, and as a learning opportunity and I've made some dumb mistakes, but that was just myself. Right. So it's like, do what works for you. There, if you're not a long-term investor and you focus on short-term, that's fine. Like, whatever, just know what you're doing, who you're following, and what works for you. And yeah, just do it. Thanks a lot, Richard. Appreciate you being a partner of 7investing, letting me come on the podcast. If people want to check us out, 7investing.com, obviously. And I think you share your link in there, which people get $10 off their first month. And so it's $7 for their first month if they wanted to try 7investing. But if not, then don't, do what works for you as an investor,
Absolutely. And I always finish with one question, and you already kind of answered it, but do you have any kind of very specific advice for people who maybe this is their first year getting into investing on maybe how to find their style that will work for them?
What do you have any unique experience or, one of the things that helped me be the investor that I am is I pulled in my job experience from being a consultant, but even from being in the military. Like in the military, in my job, I didn't even talk about this in this thing. We take risks every single day. But there's ways that we manage that risk through processes we put in place. So that made me, more prone to investing in risky companies or overvalued companies or whatever, and taking the risk of investing because I was familiar with risk and managing risk from my background. Mm-hmm. But then also, I had experience as a consultant and seeing this technology, even as a career coach and using some of these remote tools that prepared me really well to go heavy and invest in companies that I thought were going to have great remote tools through 2020. So, there's something out there about your personality, your interests, that gives you an advantage over other people in investing in life and your career. Double down on that stuff and don't be afraid to put a monthly contribution into a company and it go to zero. That's not going to matter if you're spreading your investments out and you own a number of great companies and you have a Shopify and Amazon and Netflix. If you have those types of companies in your portfolio, you're going to take some losses, but the wins are going to by far make up for all the losses and then some.
Absolutely. Thanks again, Austin. And for everybody watching, thank you for tuning in. And if you did enjoy, remember to hit that like button, subscribe if you want to see more interviews just like this one. And Austin, thanks again. Pleasure talking with you this morning. Awesome.
Yeah, same to you, Richard. Thanks a lot.
Yep. Take care, and I'll see you guys in future videos.